and we're going live on YouTube. So
Wonderful.
Yeah, I'll start the recording as soon as we can start the event. So, all right. Yeah. I'll just. I think, Usha, it's okay to start. We have quite a few folks. So.
All right.
Good morning and welcome everyone to this webinar on funding your startup opportunities and pitfalls. My special welcome to our partners, NJIT, Rutgers University, NJCU, Montclair University, FDU, MacArthur and English, MIT, R&D Council, Inc. 500, and Kaufman Foundation. I am Usha Agarwal, and I am a business leader and an entrepreneur. My association with Startup Tribes started a few years back when I was a guest speaker at NJIT. There I met this enterprising young student who asked me a lot of questions. Some of them I didn't have answer. And after my talk, he came and met me. This young man was none other than Parth Mehta, the founder and CEO of Startup Tribes. And the focus of his questions when I met him was all about the idea that he had for his startup. Of course, then I did not know. It was later then, when I talked to him further, I realized why he was asking me this question. So I have been engaged with Startup Tribes, I would say initially as a mentor for Parth, and now I'm an advisor. Early last year, Startup Tribe was launched, and it had its first success when it landed a contract with none other than MIT. But of course, then COVID happened. However, the founders helped to make a few quick pivots necessary to adapt to the new environment, demand, situations to make Startup Tribe's acceptance a success. When I was initially interacting with Parth, I found the hunger in him to succeed. Very self-motivated young man and eager to learn, and his positive attitude was infectious. These are the necessary ingredients for the recipe of success. And Parth had many successes with the competitions. In 2019, he won the Thai Global competition in which he represented New Jersey. The same year, he won the Venture Lick Shark Bait Pitch competition. He was awarded the STEM Innovator of the Year 2019 award by New Jersey Technology Council. This year, that is in 2020, he was selected by his colleagues and executives of Startup Tribes for the Most Valuable Professional Award, which we call it MVP Award. This year also brought many other wins for Parth and Startup Tribes, including partnerships with the MIT, Kaufman Foundation, Biogen, MacArthur and English, R&D Council of New Jersey, Thai University. Now, without any further delay, I invite Parth Mehta to the center stage. Parth, all yours.
Thank you, Usha, very much for this great introduction. I think that it's been a great journey, as you mentioned, starting off as a student entrepreneur and then going into the phase of getting into the real nitty-gritty work of what a real entrepreneur does. I think it's very easy to get diverted into the current social media vibe of what an entrepreneur does, but the real hard work is really tough. But I'm very happy to have you as one of the team members and one of my own personal mentors, then Dr. Suresh Kumar, a professor of practice, guiding me through the journey of the up big waves and downfalls of entrepreneurship and the startup. I think we have a great panel today with JP James joining us from Atlanta, Vijay Kohli from Jersey, and Mr. David Soren as well, our keynote speaker from MacArthur and English in Jersey as well. So I want to just take a moment to thank, again, McCarter and English, our strategic partner for this event and sponsoring us. And like I said, this year has been amazing. And it's truly heartbreaking to see how COVID has impacted us in a very negative manner, and small businesses are diminishing, and students who are not having access to STEM innovation education or even basic resources and facilities, how they were completely cut off when schools were shut down. And this year, Startup Tribes, as you know, our whole founding principle, or the foundation of Startup Tribes, was based on diversity, inclusion, and equity for underrepresented minorities and underserved communities, connecting them with STEM innovation, connecting them to the STEM pathways and opportunities that they may not necessarily have access to. So over this year, we have done tremendous projects in North Carolina, Massachusetts, across Jersey now, entering Colorado, Iowa, and now walking into United Kingdom as well as European countries. And the whole point, or the focus area for us now, is that we're more motivated and determined than ever before. I think the problem, the COVID and the lockdown, and then the dramatic failure of American leadership has caused all of us to step up at this spotlight, to kind of be there for each other. And I think that's what we've been successful at. We've built bridges between Thai University, between many support organizations, given students access to equity, access to capital, access to the resources and education. And we're going into the right direction, I feel. And we want to amplify this at not just our local city. We're actually entering the phase of making an impact at a global level by connecting these communities to the well-funded organizations and resources that we may be aware of or we're partnered with. So we're very, very grateful and privileged to be that trailblazers for that opportunity and initiative. And secondly, I just want to mention that my heart dropped looking at the percentage of small businesses just dying off due to this pandemic. And we have taken an initiative to revive the Main Street businesses, bring back the Main Street economy. So we're in discussions with multiple government organizations and local governments to work with municipalities and kind of take the Main Street economy, not just through COVID, but make it sustainable and grow through the upcoming years and make it competitive. So that being said, I want to introduce Mr. David Soren, our keynote speaker from McCarter and English LLP, one of the finest and leading law firms of New Jersey. They have been supporting tremendously the startup ecosystem of New Jersey, and especially the tri-state area. You'll see McCarter and English everywhere. Wherever there's startup, you see any startup, you'll be hearing McCarter in English, and hopefully now Startup Tribes, wherever you go in the tri-state area. David Soren is a partner and chair and a venture capital and emerging growth companies at McCarter and English LLP. And he's also the board member at Tech United. I think we're all aware of Propelify, especially if you're from New Jersey. Well, he's the go-to guy. He is the board member of Tech United. And like I said, I just clicked off with Dave, I think, and ever since our first engagement, I think we figured out and we understand each other, and we click on the basis that we're here to support students. We're here to support youth entrepreneurship, the next generation of innovation, and we understand the importance that it's the next generation that is going to push the limits. And what better day to have this workshop or seminar than just yesterday, SpaceX did its full independent launch, doing its full capabilities. So I think we have the perfect logo as we have the rocket soaring up, and the perfect panel members like Mr. David Soren, Vijar Kohli, and JP James. Right off to Mr. Soren to kickstart us off with the keynote speech and tell us more about funding opportunities in startups. Take it away, Dave.
Parth, thank you so much. It's a privilege for me to be here. As Parth indicated, a big part of what drives me every day is helping young entrepreneurs achieve their goals, because you are in fact the future. I do have a slide presentation. The slides will be available to any of you who wish to have them later on. And just a forewarning, the slides are far more comprehensive than the discussion we can have today. But my goal is to go through some of the pitfalls and opportunities associated with different mechanisms for startup financing. So if we can share the screen, the slides will come up. There we go. Thank you, Suresh. As Parth said, my name is Dave Soren. I am a partner at McCarter & English, and I chair the Venture Capital and Emerging Growth Companies practice. I'm delighted to be here with Startup Tribes and Ty, and we'll go right into it since as a professor myself, I know how little time there is. When we are talking about early stage financing, we're really looking at everything from self-help or self-financing to new mechanisms such as crowdfunding, and ultimately, as companies get to a level where institutional investors may be available to them, venture capital and private equity. There are various means of raising capital. The most common historically has been the use of what we call priced equity rounds, where the company is given a valuation. A valuation is determined, and you look at how much money is being raised, and you sell either common or preferred stock at a fixed price. For early stage companies in particular, determining a valuation before there are observable performance metrics can be a very difficult thing. So in the last 10 or so years, alternatives have been developed to priced equity rounds, commonly referred to as either convertible debt, safes, or KISSes. Convertible debt is exactly what it says. Instead of investing in equity, the investor buys notes, convertible notes, or debt of the organization. But those notes will automatically and mandatorily convert to equity based upon the valuation and price in a subsequent equity round of a particular size. Convertible notes are a great feature because they allow the company and the entrepreneur to kick the can down the road, so to speak, on the issue of what is the valuation of a company before it's proven market acceptance, had commercialization, et cetera, and allows an investor to invest today, but ultimately enjoy an economic benefit associated with a more high risk, high reward instrument such as priced equity. The problem with convertible notes, of course, is that you don't know exactly what percentage of the company you're giving up at the time of the financing, because the debt will convert based upon the valuation in a subsequent round, usually based on either a capped valuation, which is not intended to be the value of the company at the time of the debt financing, or a discount off of the price paid in that subsequent equity round. Given this uncertainty, there is somewhat of a lack of alignment between the interests of the investors and the interests of the founders and the company. When we look at this, we try to reconcile that difference by using a capped conversion price and a discount. But once we use a capped conversion price, much of the rationale for using a convertible debt instrument disappears, because although we're not coming up with a current valuation of the company, we are looking at a proxy for that at the time that subsequent equity financing would be done. The other issue, of course, is that convertible debt is a little bit of a misnomer. When an investor invests in a convertible note instrument, there's this illusion, frankly, that if there is not a subsequent equity financing, that debt will be repaid at maturity. The reality, of course, is that a startup company that brings in proceeds from convertible debt likely will not have sufficient funds to repay that debt if a subsequent equity financing does not occur. So in form and substance, convertible notes, while in form are debt, In substance, they really are a high risk, high reward security. As a result, our friends at Y Combinator, one of the leading accelerator programs in the country, devised an alternative to convertible notes known as SAFEs, Simple Agreements for Future Equity. A SAFE attempts to reconcile the risk-reward profile of the security with the realities of the company's situation. So it works much like a convertible note in that it too converts at the time of a subsequent equity financing, either at a capped valuation or at a discounted price. The difference, though, is that it's never denominated as debt. And it's a recognition that this is a form of permanent capital. The problems with SAFEs are similar to the problems with convertible debt in that they don't necessarily align the interests of the founders and the investors. And SAFEs, while widely accepted on the West Coast, are less accepted on the East Coast, especially by institutional investors such as venture capitalists and private equity investors. There's been an attempt to make SAFEs more palatable to the investor community through something called a KISS. A KISS is a keep it simple security. And if you think of convertible notes and SAFEs as being on a line, if you will, KISSes are somewhere in the middle. They're a hybrid between SAFEs and convertible notes that attempt to add some of the protection associated with convertible debt into a SAFE instrument. Now, there's a lot here that I will skip for now and ask that we go to the next slide. Sources of early stage funding. The most common, of course, is that the entrepreneur himself or herself funds the company at the beginning. This is commonly referred to as bootstrapping. One of the positives is that with all the tools and open source technology available to entrepreneurs today, many founders do not need as much initial funding to start a business as they did in the past. This form of capital efficiency and declining capital intensity has been a boon to entrepreneurs globally and certainly here in the United States. But of course, there's a downside. And the downside to that is that the entrepreneur is using their own funds. For most entrepreneurs, that is a very limited pool of capital. And so self-help may be a great starting place, but depending upon the capital needs of the company, or likely will not be sufficient to get the company up to commercialization, positive cash flow, and profitability. Next slide, please. After that, many entrepreneurs will look to friends and family. And you'll notice that I refer to this as friends and family and perhaps fools. The issue here, of course, is that these types of investors tend to be less sophisticated investors who are investing primarily because of their love and affection for the entrepreneur. They are not necessarily sophisticated investors, and that can pose a problem with respect to getting the transaction done. There's an emotional component. These are generally inexperienced investors, and one of the primary downsides of a friends and family and fools transaction is the distinct possibility of an overvaluation, because they are not sophisticated investors and they are not necessarily investing based upon any real economic criteria, but rather because they are trying to help. In friends and family transactions, you see the broad array of possible types of instruments, from notes and SAFEs and KISSes to priced equity. They are very easy to complete, and they generally have low transaction costs. But as I said before, these investors tend to overvalue companies. They're inexperienced, and usually they are not value-add investors who can bring more to the table than the check that they write. Next slide, please. One of the very common and relatively new sources of early stage funding are accelerators. Accelerators provide not just some amount of money in initial seed capital, but can provide very important and valuable additional forms of support. There is a positive network effect. Accelerators have mentors, advisors, and business leaders in various business areas that can lend their expertise. They do this without cost to the entrepreneur, and often are very good sources of introduction as the company matures and becomes ready for pre-seed, seed stage, or later capital. Accelerators are designed to take startup founders and educate them, help them turn their business idea into a functional business. They provide founders with some seed capital, usually a relatively small amount, office space, mentors, and advisors. One thing to be aware of is that there are now a large number of accelerators propping up virtually anywhere there's a startup community. And not all accelerators provide the benefits that they extol. So be careful. Study the accelerator before you approach them, and be aware of who the mentors are and what services they actually provide. But for a founder who has not been through this before, accelerators can provide enormous value above and beyond the small amount of seed stage capital. Let's go to the next slide, please. Crowdfunding. Crowdfunding is a relatively new mechanism. It's an attempt to provide greater access to capital at lower cost. The idea is that the entrepreneur can approach a much wider audience beyond the audience that would typically be an early stage investor. On the one hand, crowdfunding talks about democratizing access to early stage investment opportunities, and for the entrepreneur, provides a much greater supply of prospective investor dollars. Some of the problems here are, again, the risk of unsophisticated investors, a lack of value add on the part of those investors to companies, and for the investors themselves, there obviously is a risk of investing in opportunities that they really should not be investing in. Startups are high risk, high reward opportunities for investors and entrepreneurs alike. And crowdfunding has a place in the grand scheme of financing today, but it is not a panacea. And with relatively few exceptions, crowdfunding is more beneficial for companies that are consumer facing rather than companies that are B2B or business to business companies. The jury is still out, so it's unclear whether the new crowdfunding rules will provide the democratization they seek to provide, and whether or not they'll actually provide sufficient capital at a reduced cost to entrepreneurs. Next slide, please. So the crowd, we talked about this. This slide will be available to you, but given time, I'll ask to move on. And here we talked about some of the concerns of early stage financing. Some of these investors are incapable of bearing the increased risk associated with early stage company investments. So on the regulatory side, there is this notion that we need to protect less sophisticated investors, the so-called widows and orphans. And there is a bigger issue at large, which is possible negative effects on the integrity and reliability of the securities markets. And the crowd, as we said, tends to be less value add investors. And this is where we start looking at angels, venture capitalists, and corporate investors for some added value that they can provide. Angels and angel groups. Historically, angels were hard to find. because there wasn't a formalized mechanism the way there would be in the venture capital or private equity markets. But angels historically were successful entrepreneurs in their own right. Perhaps they had achieved success in an industry or a business sector analogous to that of the founder. And they tend to be more sophisticated than friends and family. And because of the success that they've had, they tend to be able to provide a greater value add to the entrepreneurs and the founding company than friends and family or the crowd. They're also more likely to understand what terms are negotiable and to understand what market is. And then we move up one more level to venture capital funds. Venture capital funds are institutional investors. These are investors who tend to have a preference for a particular stage of development, level of revenue production, particular industry sectors, etc. They are very sophisticated investors, and they have an institutional preference for priced equity, and within priced equity, preferred equity. Equity that has very specific terms that are greater than the benefits afforded the common stockholders, such as the founders. But venture capital funds do have extensive industry experience and can provide enormous value beyond the dollars that they invest. For founders, it may be premature to be thinking about a venture capital investor, but you want to plan for that depending upon your capital raising strategy and the amount of capital you're ultimately going to need. But I will say that there are significant valuation benefits to being a venture capital backed company. It's been studied over and over again that whether it's a merger and acquisition, a sell side exit or monetization event, or an initial public offering, that venture capital backed companies enjoy higher valuations on monetization than do companies that were never venture capital backed. Next slide, please. Often overlooked sources at the early stage. We encourage you founders to be thinking about this. There are grants such as NIH or SBIR, and there are state and local economic development authorities in almost every state. I know many of our Thai members and many startup tribe aficionados are in New Jersey, and New Jersey has some really interesting programs about, introduced by the New Jersey Economic Development Authority. One of them that bears recognition right now is something called the New Jersey Angel Tax Credit Incentive. If a company is based in New Jersey, that's where it is creating its jobs, whether it's formed pursuant to New Jersey law or not, New Jersey offers investors a very significant financial incentive to invest in New Jersey-based companies. It's called the New Jersey Angel Tax Credit Incentive. A New Jersey taxpayer who invests what is called permanent capital in a company that's building jobs in New Jersey will be entitled to a tax credit on New Jersey taxes equal to 20% of the amount of their investment, up to a cap. And if the investor is not a New Jersey taxpayer, as long as they make an appropriate application and the company is an eligible technology company, New Jersey will write that investor a check equal to 20% of the amount that they've invested, again, up to a cap. These are very important programs. Maryland has a similar program, as do many other states. So it's important to understand and determine how many programs are available and which your company may be eligible for. Another overlooked source of early stage capital, but one that does have some risk, is customers themselves. Often customers will help fund the development effort for a solution that it needs for its business. This is important because it can provide sometimes non-dilutive capital to a founder, But there are risks. Customers may ask for exclusivity, for example, or you may find yourself developing a solution so specific to your customer that it lacks broader market acceptance. And last but not least, in this particular area, are strategic partners and corporate venture capitalists. Unlike financial investors or solely financial investors, strategic partners and corporate venture capitalists often look for a particular type of company that falls within the strategic goals. There's a cautionary tale to be told here, however, and that is, done incorrectly, you could find yourself effectively doing a de facto sale of your company too early in its development. Done right, these types of partnerships can help demonstrate market acceptance, provide a sense of confidence in the marketplace, and provide very valuable both capital and other resources to the company. Next slide, please. We talked a little bit about this. We've looked at sources of capital, but then there are the types of securities that a company may issue. Common stock is what founders tend to own. It's the garden variety ownership in the company. And preferred stock, the last on this list, is exactly what it sounds like. It's stock that has rights and preferences and designations senior to that of the common stock. So when a company issues preferred stock, what goes along with that are certain liquidation preferences and economic rights, other economic rights that are senior to the economic rights of the common stockholders. Common stock and preferred stock, as we said earlier, both require that the company determine its valuation at the time of the financing. And particularly for those of you who are very early stage founders, raw startups, for example, that can be a very difficult, if not impossible, exercise. And that's why convertible debt or convertible notes, safes and kisses were born. And we already talked about some of the positives and negatives associated with them. Next slide, please. And we can roll again. Common stock, again, same stock as the founders. Valuation is usually the main issue negotiated. And if you're doing priced equity, this is better than preferred stock when raising relatively small amounts from friends and family and some angels. Next slide, please. The safe we talked about. This is a very low cost solution, and it may be the best for very early stage companies and investors like friends and family investors and angels. They're designed to convert into equity at a discount or a capped conversion price. They're really, really quick to get done at very low transaction costs. But as we said, institutional investors are skeptical at best, and some are vehemently opposed. In our practice, we have found that tech entrepreneurs and other business people tend to be the ones most interested in safes. And as I said earlier, there's a geographic preference. Talked a little bit about kisses earlier. They're safes on steroids. They are a hybrid security that are an attempt to bring some of the perceived benefits of convertible notes into the safe landscape. Next slide, please. Convertible debt, we've gone through this again, very quick, cheaper from a transactional cost perspective to get done than a preferred stock financing. It is a loan, but it's intended to convert to equity. The primary negotiating points are the discount, the capped valuation, the interest rate, the term of the loan, and the mechanisms for conversion. Again, this is a good tool to use when you can't agree on valuation, and most often used as a bridge to an equity round that is coming up. The interests of investors and founders are not perfectly aligned when doing a convertible instrument, and that's probably one of the biggest downsides. Next slide, please. Here are the negotiation points. The last bullet point I think is important to add is that convertible notes, which are intended to be fairly simple and low cost from a transactional perspective, can get more complex when investors seek additional rights not commonly associated with a convertible note transaction, such as a board seat, protective provisions, liquidation preferences, participation, or information rights. Next slide, please. Preferred stock. Generally, as I said, this is equity with some significant preferences over common stock. There are a lot of terms to negotiate, which adds complexity and cost. And I have to say that unless you're raising about $500,000 or more from angels, or about $1 million or more from venture capitalists, where there's a clear lead investors and parties can agree to evaluation, a preferred equity instrument can be rather expensive, and therefore many startup founders will prefer a safe or a convertible note. Preferred stock is most likely in a scenario after that very early seed round. But in the last couple of years, there's been an attempt to templatize preferred equity instruments, something called a pre-seed preferred stock. This is an attempt to balance the interests in having low transaction costs and simplicity with doing a priced equity round, which, as we noted, is preferred by most, at least institutional investors. One of the reasons for this is that there is another tax incentive that's referenced earlier in this presentation, but we didn't have a chance to talk about, called the qualified small business stock tax exclusion. If a company is a qualified small business, which generally means, and I'm oversimplifying, it's a technology company with under $50 million in assets. If an investor buys priced equity in a C Corp, that's common or preferred stock, and they hold that stock for 5 years or more before they sell that stock or monetize it, they will be entitled to an exclusion from federal taxable income of a large amount of gain. It's the greater of $10 million of gain or 10 times the amount of the cash investment, the amount of the investment by the investor. So anyone who invests $1 million or less will be entitled to exclude up to $10 million of gain, and anybody who invests over $1 million can exclude up from gain up to 10 times the amount of their investment. This was made a permanent part of the tax code the federal tax code in 2016, and therefore has become a very important consideration for any investor. And pre-seed preferred stock provides a great balance between convertible notes and safes and kisses on the one hand, and a typical National Venture Capital Association Series Seed, Series A or beyond transaction. Next slide, please. There is increased emphasis on simplicity and cost effectiveness. This is intended to benefit both investors and companies, and frankly, an attempt to forego some of the intermediaries that are involved in financing early stage companies. Next slide, please. Observable trends. There's a clear and increasing preference for priced equity, even among early stage investors, despite the ubiquity of notes, safes, and kisses. And traditional early stage investors, even at that startup round, are acting more like later stage investors, seeking the rights, preferences, privileges that previously were associated with professional and institutional investors. And even though that's true, the terms have become more founder-friendly in recent periods. Of course, we now have to consider the impact of the global pandemic. And for a bit of time, especially in the April-May timeframe, it appeared as though terms were becoming more investor-friendly. But after that initial knee-jerk reaction, things seem to have settled down, valuations have normalized, and COVID-19 has not caused an introduction of significantly more investor-friendly provisions. And as I said earlier, QSBS has become a qualified small business stock tax exclusion has become a major driver in how these deals are getting done. Next slide, please. Some of the trends: median valuations are increasing despite the gray clouds. The number of dollars being raised is increasing. Almost every deal from angel on up includes investor representation on the board of directors. But interestingly, even though it's become a little bit more difficult to get financing, few deals involve something called participating preferred stock, which I refer to as kind of 2 bites at the apple. We'll leave a deeper discussion of that for a later time. Virtually all, sorry?
Oh, sorry about that. I just wanted to chip in just to mention that we have a couple of questions being sent in. So I was thinking that maybe we can address these questions or talk about it in the panel discussion as well, because
Perfect.
This is great information. And I think that if we can connect it with some questions I'm getting and some questions we're all getting through in the Q&A, through the panel discussion, we would like to address that as well. But by all means, you can continue, and then we can go ahead into the discussion in the next minute or 2 minutes or so.
No, let's go right into that. I don't want to cut into the time for the panel, so happy to take any questions, or looking at the time, perhaps we should go right into the panel discussion.
Okay, great. So I'll just get all the panel members on, if we can have Vijar join in. And yeah, I think I'd like to introduce Dr. Kumar, and he's been one of the driving factors behind how Startup Tribes came to be. And I think if you have the right mentor in life, you can reach new heights. It's all about who is guiding you, who is your leading light. And I think Dr. Kumar has proven it through his professor of practice, but I have tremendous respect for him professionally, but also personally, because I go to him for any life problems or business problems I have. Dr. Kumar has been an Inc. 500 entrepreneur. He's a serial entrepreneur, made multiple successful exits, and he has instilled his ideologies in me. And just like Dave gave his amazing speech, I think that he is a great mentor as well, where we can all learn from, not just the technical things, but it's very important to have the motivation and the driving force and the purpose to help others, to better the community, and also support and empower the youth at this point of time. So I'd like to have Dr. Kumar enter as a panel moderator. We have Mr. JP James. He is the lead investor and chairman at Hive Financial Systems. We also have Mr. Vijar Kohli, and he is the co-founder of Golden Door Asset Management at New York. And Mr. JP James is also a guest lecturer at Georgia State University. So we're very happy to have you guys. And let's start off with the panel discussion, being the topic of funding startup opportunities, the pitfalls, and the great opportunities that this land has to offer of capital.
Thank you, Parth. So you've given me an additional title of a life coach. I appreciate it. But I just wanted to mention that it's been a privilege mentoring you, and it's been with great pride that I've been watching your growth. David, thanks for that wonderful discussion. We covered a lot of great grounds, and hopefully we'll flush out some more as we speak on the panel. There's a few topics that I wanted to cover, and I'm going to direct the questions to one of the panelists. And in the interest of time, I initially had 2 minutes in mind, but I'm going to bring it down to about a minute and a half per panelist. And after that, the remaining panelists have an option to respond or add to, or maybe counter with within 30 seconds. So that's the format we'll start. And I'm going to start with a question maybe to you, Parth. There has been a big emphasis on pitching for funding, right? So whether it is within a university setting or within the Thai university competition setting, etc. But a 2007 study of Inc. 500 founders found that 85% of those Inc. 500, and these are the real mainstream entrepreneurs, right?
Mhm.
And that 85% were bootstrapped. Just 1% was VC funded. So the question I have for you, Parth, is can you share with us your experience with getting a startup up and running by bootstrapping?
Sure. I think I'm a true believer of revenues talk more than just asking for money. It's better to make money. Um, but I understand your point because as I started as a student entrepreneur in the final year of college, there's this whole buzz. I think TV shows and these big startups in the news come out and say they made an ask for $50 million or $10 million, $2 million. And I think that's a buzz if you don't understand the market correctly. A lot of times we see youth entrepreneurs make a big ask where it's just an idea or they're still testing the market, they're still looking at proof of concept or product market fit. And a lot of these ideas may not necessarily even need that amount of capital that they're asking for, right? One big example is Startup Tribes. We are, I say, a team of ecosystem builders, and we're a SaaS-based company, software as a service. And I know a lot of entrepreneurs who run a SaaS company, but they have this AI and they feel that by using the buzzwords AI, machine learning, they're going to attract investors. But that's not how it works. Investors know exactly what that means. I say investors are even bigger experts in the vertical they're in than any professional with any X amounts of years. And the significance of this is if you bootstrap, you hold the power, you hold the equity. And I think I don't want to glamorize that because you need to make an ask where you need it. But looking at Startup Tribes, we bootstrapped from day one. The core team, you can ask your friends, you can ask your family, you can put in your own money, and you go until a point where you have proof of concept. You are getting market acceptance. You're going into revenues. Luckily, Startup Tribes over a period of 12 to 16 months, we made double on our own founders' seed capital. We are breaking even and we're making revenues. That itself attracts a lot of investors. When you go to an investor and you say that, hey, we need money to scale up. We need money to go from 12 customers to 25 customers in the next 6 months or 7 months, or grow from a monthly recurring revenue of $15,000 to about $80,000 or $100,000. That's when investors will really get in. But to kind of sum up why I feel that Bootstrap is also more attractive is think about this. If your product is not aligned or it's something that you really love and it's still being accepted but not at the rate that you want it to, if an investor comes in, they have full authority to guide you or take that away. And then they become the driving force. So you're kind of compromising, and I've enjoyed the liberty of testing out different business models. I think just like 9/11, the startups that were in 2000 got hit with the whole 9/11 market who are based in New York City. We startups have been hit with COVID. And if you don't adapt, if you don't change your business model, if you don't change the roadmap or projections and stay stubborn to stick with whatever you were pre-COVID, that's not going to work. And once you bring in an investor, you kind of have to start following their guidance. And I feel that having the right mentors, right core team is the key. And just to give you guys a flavor, I think the average age, I just want to mention that one of my instructors or professors I really admire had given me a statistic that the average age for a successful entrepreneur is 43. 43 is an average age for a successful entrepreneur. But you can play the game, right? You can play any game by this. in my team, I'm the youngest person. I'm younger than the most junior coder in my company. So the way you make it up is you bring in everybody who has expertise and experience. And the way to do that is build trust, share the vision, and have everybody on the same page, because that goes a really long way, not just with their team, but if you establish that trust, you build customers, and customers means investors are looking at you, and then Bootstrap goes into scaling up, going into other series funding.
Thank you, Parth. Great response. Opening it up to the panelists. Anybody wants to add to this? Open to any panelist, 30 seconds.
Sure, I'll chime in. Can you hear me? This is JP.
You can.
So I'd say out of the 16 companies that I've started, only 4 have worked out, fourth being the one that I've just started. So I've done the bootstrapped, I've done the VC raise, I've done the friends and family, the debt financing, the warrant structures, almost everything that David was talking about. So great to kind of hear the variety, and actually going through the experience, I think it just depends on your business. So one of the first companies that worked out for me was a distribution business. It didn't have IP. It was a huge amount of free cash flow. So I wasn't going to go after venture capital. There wasn't anything unique about that IP, even though we had built some technology. So that's where raising capital ended up being more friends and family. But we were able to get a lot of the work going ourselves. One of the other companies I started was a services business. Similarly, bootstrapped, did not need to raise any capital. Revenue was generated pretty quickly. The last 2 companies, they were venture backed. So we had a huge amount of capital that we needed to raise. This latest company, I've raised almost 40, 50 million in the last 30, 40 months of starting the company. In my hedge fund, which is completely different, which I had for 15 years before I sold that, we raised almost 1.6 billion. The general partner, when we were general partners, we've put in our own capital to get the company off the ground. So it really depends on what you need. And I would say there's a balance. If you are able to time the business relative to the outcomes, you can sell just enough that you don't have to lose control in the process. No sophisticated investor wants you as the early stage entrepreneur where they believe in your leadership to lose control and be disincentivized to grow the company successfully. I've actually seen recaps where owners have been given a lot more equity because they have been diluted so far down that there really wasn't an incentive for those entrepreneurs that were still guiding the success of the team to stay on board. So the recap was agreed to by all the other investors in previous rounds to give more power to the entrepreneur from that standpoint.
Great. Thank you. David, you had something to add to that?
Yeah, if I could, when you listen to what Parth and JP just said, it's so critical to understand something that a very wise venture capitalist once told me. And that is, first, not every great idea is a business, and not every business is a financeable one. And, JP's comment goes right to that. It all depends upon the capital intensity and capital efficiency of the company and what it needs to achieve its goals. If you don't need to raise outside capital, you shouldn't. And that's one of the very important things that I hope everyone hears from this program. Once you make the determination that you actually need to raise capital, that's when we should explore the risks and rewards associated with that. But listening to Parth and JP, that's exactly what an entrepreneur needs to hear.
Great point, David. Thank you very much. I'm going to jump right into the second question. And so this is about kind of a continuation of the first question, which is that there is not enough discussion on when a startup is ready for funding. So how do you determine that? Most founders, frankly, and especially university founders, are a little lost in that. So this question is to Vijar. He has a lot of experience in this area. So given your experience as an investor, what are some of the recommended metrics founders should keep in mind to determine if their startup needs funding? Over to you.
Thanks, Suresh. So I'll keep it brief. There are 2 areas where you need funding. First, the first metric you should always look at are lead measures. So net new sales. So sales is your driving force for any business. If you're not producing revenue, like Parth said, then it's really difficult for someone to fund that business to fuel more revenue growth. So that's what most businesses should be focused on. If you're very scientific or you're focused on a lot of code development, then you're really funding development of product, which you might need a lot of capital to get behind that business and to get it to a certain stage before it goes to market. So the first one, sales based, I don't think you should raise funding until you're bursting out of the seams and you really can't hold the business together and you need more resources at the end of the day. So funding will be used to hire new team members, to bring on C-suite guys, more experienced level people. That's what I think you really need funding for when you just can't handle the growth. And then the second one is development. You just can't do all the development yourself. So those are the two areas I think so you need the most funding, or where the funding is most in demand.
Thank you, Vijar. Any other panelists want to add to that? David or JP? All right, moving on to the third topic. So there is a mistaken notion that fundraising is easy, and it's as easy as making a pitch, right? So the reality is fundraising requires much higher level of preparedness. And David, you did cover it, but the question is to JP James. How should founders prepare for fundraising, and where should they start, particularly given the resurgence of COVID and the difficulty of actually meeting face-to-face with an investor? That's what I've done with all my fundraising in the past. It's always been a one-on-one discussion. Now that that's impossible, where do you suggest founders start?
Great question. Especially since the last 20, 25 years, I feel like I've been raising capital instead of building companies. But no, I think that's the step one. If you are going to raise capital, you have to accept it becomes a second full-time job, and it never really ends. I always keep saying that someday maybe I'm going to finish raising capital. The moment that I think that's the case is never the case. Whether it's the small, and there has to be a context. So I remember I had an entrepreneur come into my office and say, "Hey, I'm trying to raise $500,000. It's a startup. I'm just getting going." And I said, "Well, how much have you raised?" They said, "We haven't raised anything." And I said, "Well, who have you talked to?" They said, "I've talked to all these VCs. Nobody wants to invest." I said, "Can you raise $500? And they said, "Yeah, I could raise $500. That'd be pretty easy." "Well, what about $1,000? And I got to the point, I think they said they could probably do $5,000, but no more. I was like, that's actually the answer to the question. So you've got to go to the level where you feel comfortable and then keep raising. I can raise literally right now, if I texted I need $1 million or $10 million, I could get that wired in. You get to the point where you feel comfortable that when you're asking, you understand the other person's situation, you understand what they're looking for in their opportunity, and that what they're looking at is that trust that you have with them of being a good steward, of creating productivity with that capital. So end of the day, even having raised hundreds of millions of dollars, it comes to trusted relationship. It could be institutional capital, it could be VC, it could be small, it could be your dad. I'll be honest, I remember the first time I raised capital for my dad. To this day, decades later, it's still something that's looming over me because my dad thinks that I owe him everything that I've got because of that first amount. No, but the reality is, even today, when we're raising capital, everything is relationship driven. Somebody has to know you and trust you. This is a human thing. It's a human exercise. And I think a lot of us, when we're in the early stage, we think, oh, there's a VC, they're a professional, and this is a professional transaction. And the reality is it's not. It's a human transaction, and there's a trust component to it. And the people that are going to help you raise capital are the people that trust you. So they may not have all the capital, but they know other people that may have a little bit more capital. And I remember even with this company, other than putting my own capital in, raising money from my board and the initial trust, it's asking people who already know me, that already trust me with an amount that I know that they'll feel comfortable giving to me. And I feel comfortable taking from them and being a steward of. The other thing is I always say, like, especially whenever you start raising capital all around the world, and you build relationships there and you put your, you basically put roots in. That's also a big factor. If you're living in New Jersey or Switzerland or Atlanta or wherever in the world, people want to see that you're stable. When I was in college raising capital, it's very hard to convince somebody that I'm stable. I thought I was stable and I thought I had great ideas. But looking from the outside in, it's like, well, if I take the capital and I burn it and I leave, what does JP have to lose in that situation? Maybe not a lot. But I'll tell you now, if I lose, it's a big deal. I've got friends and family. A lot of the people are investing, even the institutions are a part of my life. And so they know there's a much higher level of risk that I have, that if I lose that capital, that there's going to be consequences. So like I said, even with COVID, it's all about relationship. It's the people that trust you and you build trust in that can refer you to other people. And most of the transactions that we do after that, after you understand that, is yes, it's relationship driven. And yes, you want to meet with people relationship. But honestly, you know, Suresh, you and I connected a couple of years ago at a TiCon in Silicon Valley, and we reconnected from this way. And, you know, all those years when you're spending time in the community and you're creating impact, people are watching that. So even if you're doing nonprofit activity and other types of activity, people watch how are you being responsible in your community, and are you going to be responsible with the capital that they've given you?
Thank you, JP. I think you have raised a very fantastic point, which is trust and relationship. I just wanted to quickly share an example of this that I had. Following 9/11, my company, one of my first company actually, was pretty much close to bankruptcy. And I've been talking to an investor for almost 3 years. And as you rightly pointed out, he's been quietly watching me, right? He's not accepted. And frankly, I've been asking him small amounts of money. And all of a sudden, when I was in a very tight spot, not able to pay out a payroll, I just get this $50,000 check in the mail. And that really saved us. It kind of gave us that fuel for the next 3 months. And then the tide turned, things turned around. Subsequent to that, I actually called him and I asked him, what about my business really impressed you? And he told me that I have not read your business plan. It is just that I trust you. And that was a turning point where I realized that it is all about trust, credibility, and exactly the points that you raised. So thank you. I really appreciate that response. Just want to quickly open it up for others to comment on, other panelists on this particular point.
I just wanted to quickly jump in, just because I don't think we have quite a few folks from NJIT, my alumni. I'm an alumni of NJIT. But the essence, I think JP James, I think he summed it up perfectly. There's nothing more than trust in this world. I say it's the most expensive commodity anyone can have. It takes a lot of time to build and it takes seconds to break. And once broken, it's very difficult to rebuild. Or it's almost impossible to reach that level again. And that was instilled in me through my mentor, Dr. Kumar, once again, because relationship-driven sales is very underestimated. I was actually told by folks who are the directors of leading incubators and accelerators in Jersey and New York that, hey, you need the best technology to make a sale. Like, relationship is outdated and everything. And I stay true to this ground, and like for what JP just mentioned, that there's nothing stronger more than relationship building, or nothing stronger to build that trust with your clients. And I take it forward to your core team, right? What do you have to offer them? You're not going to be offering them payrolls from day one. Everybody you're bringing on, advisors, your investors, and anyone, it's built based on trust, your clients. And I think we have 3 great investors here, and everyone would agree to the comment saying that an investor is not investing in the product, they're investing in the team. And I live by that, and I just want to emphasize on that point that whatever you do, build the right relationship, build the trust, be with your client, be with your mentor, be with anybody in life. It goes much beyond than entrepreneurship and innovation. And once you have that repo built with your client, oh my God, it is a phenomenal feeling. They're going to stick with you through life. And I can assure that, because the clientele we have built, we don't even call them clients at Startup Tribes. We call everybody partners, right? Because client is just a one-way stream or whatever, a very formal term. But right now we want to build bridges. We want to build partnerships. So one thing we do at Startup Tribes is if we have a partnership in place, we open that up to other partnerships and we build and connect these resources that Vijar, JP, Dave, Dr. Kumar, Usha, we all believe in. And that's what trust does. That's the power of trust, and never break that trust.
Thank you,
right?
Bob.
I'll
Thank you.
chime in, Suresh, may I?
Yes, please.
Okay. Parth, you touched a very important point. That's trust in the team building. And like you, Suresh has been my mentor. I've been working with him. I've known him for more than 15 years. And that is what he gave me, what he taught me, is trust. And that comes with what? Transparency and integrity. That is what the core value is. And that is not only with your core team, I would even extend it further to every employee, every member of your company, of Startup Tribes, or any company. And that is where the growth comes from. We have employees, the company, we exited the company, but we have still employees that call and within 5 minutes, we get a response. So that is what I would say trust brings in. It's not about money. Believe me, it's not about money. It's feeling about being empowered. It's feeling that, okay, these people care for me. You are investing in them. And that is where loyalty comes. It's a two-way street.
Thank you, Usha. Appreciate it. I have a next question aimed at Dave. So even assume you succeeded and you've got a few investors or customers, like you mentioned, interested in funding your startup. Those of us who will be in this panel know that there is many a slip between the cup and the lip. So based on your vast experience as a legal advisor to so many startups, what are the pitfalls, legal and otherwise, that founders should be aware of as they seek their first round of funding?
It's a great question, and it's consistent with what every one of these panelists has said already. Every business person is taught KYC, know your customer. And I would say that KYI, know your investor, is equally important. You really have to take the time to make sure that the investor's interests are aligned with your goals and strategies for the company. Done right, outside investors can bring value-add networks, resources, connections, industry knowledge. But there are downfalls, and Parth spoke to them initially when he talked about bootstrapping. There is some level of loss of control when you bring outside investors in, especially outside investors who are pure financial investors who may not have the same ultimate focus and goals that you do. There can be a shift in priorities as a result of bringing outside investors in. And there can be some differences in goals. Institutional investors, for example, may have a different timeline than you will. Institutional investors like venture funds have a life to a fund. Know what stage of investing they're at, because that's going to dictate, at least on their timeline, when they might want to see an exit, when they can monetize. And so the best thing I can say to you is KYI, know your investor, know what their interests are, build that trusted relationship that everybody referred to, and understand that bringing in an outside investor comes with costs. You have to do a risk-reward analysis on whether or not that is worthwhile, whether the capital they bring into the company and the other resources they bring in justify the risks associated with control issues, priority issues, et cetera.
Thank you, Dave. Great response. Anybody else wants to add to that? I'm going to move on to a few case studies. This is coming with actually real life student teams that I'm working with. And I just wondered if you can give me a 10-second response to what they should do. So case one is a student team has validated an idea. They don't have paying customers yet. They need about $10,000 to build out an MVP. So what are the options? Vijar, can I ask you to maybe respond to that?
Yeah, first I would say, how did you validate the idea if you don't have any customers? So that might mean that you haven't validated it yet. But if you need...
Can I just respond to that? So they have done a customer discovery with potential customers, not real customers, but potential customers.
Got it. So I wouldn't define that as validation, because validation is the exchange of money in my eyes. But if you need to build a $10,000 MVP, I would look at all the no-code platforms, Bubble, Airtable, Webflow, anything that could provide a no-code solution to create the interface, the user experience on how the product may work. It's going to be a quick product case, but it will be less than $10,000. You could actually do it yourself. A lot of people do, and that's the best solution.
Thanks, Vijay. I'd like to add a couple of points that Dave had raised, which is funding through grants. So you have grants from NSF and all that, and usually some of them are like $2,000-3,000 per team, which can also help with respect to getting these things done. But great points. Here's the second case, which is that you have a university team of 3 founders that has some traction. So they've got customers. They won a pitch competition and they've won a prize money, 25 grand. So 3 co-founders, but 2 of them recently has got job offers. And let's assume this is Google and Apple. So it's 6-figure jobs that they just cannot, difficult to refuse. So what should the remaining founder do with respect to the cash money that they have just raised? Should he or she even move forward with the idea? Can I ask JP maybe to take the lead on this?
Yeah, so just to clarify, so the entrepreneurs have traction, they've raised capital, but they're thinking about getting a job?
No, 2 of them. Of the 3 founders, 2 of them have got job offers.
Yeah.
That's what puts them in this difficult
company that I mentored with this exact same situation. In fact, there were 3 entrepreneurs. It was actually a company I ended up investing in. 2 ended up taking a job. The biggest issue in that process was the way the cap table was structured. So the expectation was that the 3 co-founders were going to be fully dedicated to the company, which is pretty typical whenever you're raising capital, at least from somebody who knows about investing. So when those 2 left, they had to figure out how to compromise, give up some of that equity. There was a little bit of founders' equity that was kept for the 2 that left. For the 1 that stayed, obviously this was their business and they wanted to focus on it. I think it was actually on a panel with Tim Draper from Draper Fisher Jurvetson on this actual topic. Have they ever gotten capital back from an investor who didn't need all the capital? Now, I would say if all 3 entrepreneurs say, hey, this isn't a good idea, yeah, go ahead, create the goodwill and return the capital to the investor. I've literally never saw that in my entire life, but theoretically, it sounds like a good idea just to build, rapport with the investor if you want to do business in the future. But yeah, I actually had another company where, as Venezuela was collapsing, there was 3 entrepreneurs. 1 had an offer from Goldman Sachs and 1 had an offer from Google. Okay, these are not low offers. The 3rd entrepreneur ended up pulling the trigger and building the company, but the other 2, 1 because his family was in Venezuela and they needed cash, he ended up taking the job at Goldman Sachs, getting the income, and it ended up working out from that standpoint. It's a tough call. I'll be honest, one of the notes that I put here is, for those of us who haven't had family members that have built companies, I will tell you the pressure from family, from friends, and from everybody around you is to do not entrepreneurship. They're like, hey, this is a great thing. I'm glad you had some activity and hobby whenever you're in college. Okay, now it's time to grow up and get a job. And that pressure is very enormous, especially in the Indian community. It's ridiculously enormous, unless your family members have been in business before. And I had a lot of that pressure where I had to decide, hey, do I go down this path of potentially getting a job? For me, it was not a question. And that's kind of a thing that you have to come as a student. If you're growing up and you're like, hey, what do I do? You should get to the point that you can't not do something. And what I mean by that is this last company I started, there's no logical reason to start a company except in your brain. It's this thing that you think is logical and rational. But I usually get to the point where I can't not start a company, where all the math and the odds are in my favor. I don't know if it's going to be successful, but I can't not do it. And that's kind of the way that you have to come up with it. If you can't not build this company or this idea and your whole life is in it, then you should probably go get a job. Because I always write this word down. I tell it to everybody. living nightmare. There's no such thing as a company that works out according to any plan. Nobody's like, I wrote it down on a piece of paper and magically it all worked out. It's never happened. There's no successful company that does it. If you want to do that, go get a franchise, start a gas station, do something that everybody has done it before, and there's kind of a roadmap for it. But when it comes to fast growth venture creation, there is no roadmap that ever works out. And so you've got to come to terms with that. You're not going to be paid. So yes, I've built wealth now, but I haven't taken a paycheck. It's almost 4.5 years in this company. Yes, it's doing extremely well. The team is doing well, but that is a conscious decision that you have to recognize that your life may get delayed. I remember I delayed getting married by 5.5 years because we were building the hedge fund. It was doing really well. The crash happened in 2008. And you can't plan for a crash. Well, maybe you can to a degree, but I said, hey, I'm going to wait my life for several years to start family and get things going, focus on the company, make sure it's going to be healthy and work out. There's no way that I could have ever planned that that's going to be the case. So I think the biggest thing, whether it's a job or not a job, building a company or not building a company, you got to be able to accept the consequences, which can be very terrible. And it's going to be potentially completely against everything that everybody around you is telling you. So if you're willing to take that on and you believe 100% that this is what you were born to do, then it makes sense. Otherwise, go get a job. It's a lot easier and you can probably make a lot more money with a lot less stress in a shorter period of time.
Thanks, JP. I love the energy you have. I'm a couple of years older than you, and I had the exact same experience in 2001, 2, 3, that recession. And I pretty much put my life on hold. And I love your concept of you just cannot not do it. So that's good.
I just wanted to mention it because I think I experienced the same thing over the past year, JP, that you mentioned, right? Like, it's literally you do the company or you can't breathe. You literally just cannot wake up in the morning and not do it. Like, I was working in a fintech company as a security engineer, and I made phenomenal growth in that company itself. Like, I was into a mid-level position in just my first 6 months, but you get the good pay in New York City, ideal job, everything at Times Square. But if you feel that you still cannot do that, then you just have to do it. And you had to accept the consequences. There is a higher chance that you will end up not getting any money while your friends are making 6-digit figures. They're going out partying on weekends. Like, I think Usha has seen me work in the past 2 years. Like, the first time I took 2 days off in a row was this February, where my friend literally drove down from Boston and pulled me out of my apartment. And I had an anxiety attack of not working. I was like, I was so used to 24/7. Right now I have 20-hour work days. And it's crazy, but that's the life you are living. It may be delayed, it may not be delayed, whatever it is, it's a process you need to love. You need to love being an entrepreneur. You can't love earning money because you're going to get job offers. And for Dr. Kumar's students, I think I've gotten a lot of questions from other student entrepreneurs, and as JP mentioned, is that if you're looking for good paid jobs, I think then take the risk, dare to dream, because what happened with me, I got a job from, I won't disclose the company name, but I got a job where they exempted a 12-year experience and they offered me a product manager position in a multinational corporation in New York City. And that was a mid-level 6-figure job. And this is purely based on my experience of running a company, running a team, managing clients, understanding investments, and how the product market works. So you learn so much more as an entrepreneur than you can even imagine being a professional. And I think that if you're worried about getting a job, then think this: you're 23, you're 25. I think until the age of 28, you really are not losing out anything. You're not losing out any years. You can always get back. But what you're building on the other end is a resume that they've never seen before. Think about this: when you apply for a position, how many of the people are going to have a resume saying that they worked with investors, they worked with clients, they worked with building a team, they worked with releasing a product? It's just impossible. So I'm a strong believer as a young entrepreneur. And I think in one of the classes of Dr. Kumar, when I was a student, he mentioned that it's now or never. When you graduate from college, you literally have nothing to lose. Like, And I strongly believe what Elon Musk says about entrepreneurship. I think Vijar, JP, Dave, Dr. Kumar, everyone will agree with this. It's entrepreneurship is like chewing on glass while getting hit with a baseball bat. Like, it's nothing feels good, but it's just something you can't give up. Like, you just can't give up.
Parth, thank you very much for that. I appreciate the fact that you quoted me along with Elon Musk in the same sentence. So I really appreciate it. We are out of time, but this was a great panel. I think there's some fantastic questions in the chat box, but please send it over to Parth, and we will make sure that you get a response from one of the panelists over the next couple of days. So thanks to all the panelists, and over to you, Parth, for the closing comments.
Yeah, thank you guys. I want to just thank our phenomenal panel today, Mr. Dave Soren from McCarter in English, Vijar Kohli from Golden Door Asset Management, and also Thai New Jersey, JP James from Hive Financial Systems and Thai Atlanta, Usha Agarwal, our business dev, and also my mentor, and also Dr. Kumar, my chief mentor. And I'm very grateful and thankful for every one of you, because today Startup Tribes is where it is because all of you matter, and because all of you helped out and support us, and ongoing support is tremendous. I can't thank you enough. I would also like to thank everybody who has attended the event. We are here to help you all. So feel free to send out questions to me. I shared my email, pmeth@startuptribes.org. Hit me up on LinkedIn. And I think our panel is just so friendly and engaging. I think they won't mind coming back to you, answering your questions. And this is just the first inaugural event of Startup Tribes. We will be doing continuous events going forward, where it's going to be based on your questions, what you feel are the problems, because there's been enough events, enough organizations that are doing their agenda. We're here, as I said, to build ecosystems, and more importantly, engage the youth community with innovation and entrepreneurship. There are tremendous amounts of resources out there. And with Startup Tribes, I think there's one question that came in, that how do we connect with angel investors, and how do we learn about the accelerators in the community? Well, I want to give you guys an update that as a Startup Tribes platform, we are still growing, and it's based on active customer feedback. We are building an engine where we will be matching the startups that are part of our community, part of our ecosystem, with the investors that are interested for that stage of that company, what vertical they're in. So we're going to be having that machine. And like I said, technology is a tool. It's nothing that can replace humanity, the human touch, and just what JP was emphasizing on, trust. We want to build that trust. We want to build these tools to help you engage and empower the youth community and youth entrepreneurship. And we will see you next time. And in the meantime, if you feel that we can help your community out, we can connect you guys or your neighborhoods, your academic institutes with STEM innovation education, where they can benefit from other ecosystems like Thai or McCarter in English, or our Startup Tribe sponsors and partners that I just mentioned of, just let us know. And I think all of us are here to help, and I will route you in the right direction. Thank you guys. And once again, I'm very grateful and thankful to have you guys over as our discussion members.
Likewise.
Thank you, guys. Have a good day.